Welcome to Portfolio Briefings, a video interview series where we discuss the impact of COVID-19 on pension funds. My name is Mona Dohle. I'm the Deputy Editor of Portfolio Institutional. And with me today, I've got Andy Cheseldine from Capital Cranfield and his colleague, Kevin Wesbroom, also from Capital Cranfield. And they're both professional trustees, and Kevin is also an actuary. So they will be sharing their views today on the impact of COVID-19 on pension funds. Welcome both of you. Thanks for joining us today.
Pleasure. Thank you for inviting us.
So first of all, how are you both managing with the situation?
Personally, great.
I think,
I
think it's been really good.
As Kevin will tell you, my body is a temple, apart from alcohol consumption, obviously. So it worked really well.
Okay, well, that's good. That's good to hear. How are you managing operationally with the situation, a lot of people working from home?
I think it's working. My experience of the pensions industry generally is it's coping remarkably well. There's really not that much excuse for things being less than they were before. In fact, if anything, I think my one comment would be, I think the pensions industry is coming out of this rather better than it went into it.
Mm-hmm.
Ches, I don't know what your experience is, but I think meetings are now far better organised and run and structured than they were before.
Okay, but that's on an operational level, I presume, not on the investment portfolio side of things.
Well, yes, it is the operation. So, you know what used to be like. A trustee meeting used to be 6 hours of a day set aside for people to run through everything. You know, investment would be 1 hour tucked away inside there, but everybody's lost the will to live by the time you get to 3:30 in the afternoon, you know. So I think people are rethinking how they run meetings.
Mm-hmm.
They are far more focused on getting the background stuff out of the way. Let's not take 3/4 of an hour to go through the minutes of the last meeting and the actions arising. Let's actually think, what do we want people to listen to, make a decision about, and let's focus the meeting on that. I don't know, Ches, is it just my meetings or yours go that way as well?
I agree entirely. They're better focused. They start on time because people just have to dial in. You don't have to worry about people being late because of trains or traffic. As Kevin says, we're running them as shorter meetings now, I think, but that's just more efficient as opposed to trying to rush through things. And we are making people read papers in advance, which, to be fair, didn't always happen before.
Okay, that's interesting. Surely you'd expect that, like.
I think the tricky side is often it's not so much if there's a subject you've got to make a decision on. Yeah, you've got to decide on your valuation result or whatever it is. I think the trickier ones are new subjects where you need a bit of time. So pick a random subject today: ESG, climate, responsible investment. Something like that isn't something that you can have 20-minute presentation, bang, 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 done at the end of it. It's something that trustees need to have a bit of time to work their way around the subject, to listen, to probe, to ask questions, to put their hand up and say, I don't understand this, and that sort of thing. That is a little bit more difficult, but again, I think people are being far more creative. So ESG is on the subject of one of my meetings. We've sent people tons of background reading, as Andy says. You know, there's a lot of background reading which is taken for granted now. So there's a lot of background reading there, and the time on the meeting will be then to ask questions of the investment advisor. What does this mean? Is this just green mail? Whatever the questions are, they're much quicker at getting to the heart of the issue, I think.
Okay, so the quantity of meetings might not have increased, but the quality has?
Yeah, I think that's probably right. I mean, one limiting factor is the number of people in the meetings. So from a technical perspective, we were talking earlier, I've run meetings today, or been in meetings today, on Zoom, Google Hangouts, Microsoft Teams, Skype, and they all have their advantages and disadvantages, but none of them work particularly well if you've got more than half a dozen attendees, because getting a conversation going can be quite awkward.
Yeah, yeah. No, it's very hard to replace actually personal contact, I imagine, in a lot of situations.
I think that's right, Andy. I think, sorry, Mona, you were saying about you've never chaired one before, but I think there is an obligation on the chair to use the facilities of the video conferencing to just look around, look at those little thumbnails and see that Mona has turned her head to the sky or whatever. Try and read the body language in some senses and see that Andy has switched off completely now. Is that because he'd rather be playing golf, or is it because he's not understanding the subject, or what? So I think it does put a bit more of a sort of quite hard responsibility on the chair to try and make sure everybody participates, and that's not easy. I think most of us are learning our way on that.
Yeah. Now, if we're coming actually to the financial side of it, obviously it's the first quarter of this year has not been very pleasant for pension schemes. Have you come across suggestions that contributions should be suspended, sponsor contributions for pension schemes, as a way of managing the crisis?
Yes, and most at least have had some justification. Some have just been trying it on. They've been so we have briefing days within Capital Cranfield. So there's 40 odd professional trustees, and we share experience with each other without naming names. And it's clear that the majority of pleas for deferrals have been justified, but there are always some that will try it on a bit.
Okay. How do you distinguish between that? You obviously have to see then their financial, look at the financial situation of the company.
Yeah, you've got to look at the details behind it. So when someone says, "Oh, we want to defer making deficit contribution for 3 months," or in some cases, for a year, you say, "Well, no, that's not on." But you say, "Why? What's changed?" And okay, coronavirus has changed. What has it changed for you as a business? So you need to understand the details. You can't just say yes to everything.
Yeah,
and as Andy said, some people are trying it on. You get some very strong parent companies who say, "We've read that we don't have to pay contributions to the UK pension plan." There may be overseas companies involved. We don't have to pay contributions to the UK pension plan. That's okay. By the way, we're paying twice as much dividend to everybody in our company, and we're doubling the chief executive's pay. No, come on. It's got to be consistent with the other corporate actions. But I think where it is justified, and there are plenty of cases, I think the regulators struck the right balance in terms of supporting the genuine cases. I think they've probably called that one right.
Yeah. And it's worth saying there have been equivalent sorts of conversations on DC as well. In the master trust environment, there have been a few employers who said, "Oh, well, we're going to stop contributions for a period." You've got to say, "Well, no, hang on. If you're paying people, you've got to carry on paying contributions. If you furlough them, then you pay contributions on the reduced amount because you're being paid that money by government." But what we might do is say, "Well, we'll wait a little bit. We won't have to report you to the regulator for late payment until you've actually had your furlough payment in from the government. But don't be worried about time delays. Just don't go stopping direct debits," which is what we saw originally from a few.
Yeah, I think that was my experience as well. I think some employer, and there it really would have been helpful, I think, for the government to be far more directive in terms of what they said. So I think some people just sort of hit the cancel the direct debit button straight away. First thing. I think if the government had said, "Here are the ways in which you can genuinely suspend, reduce, defer, defined contributions, I think that would have been helpful, rather than it just being, I've done it now, and you've got to work quite hard to make me start again.
Yeah.
And if it was clear, you know, this is a 3-month period during which normal rules are suspended, but at the end of it, it happens again. I think you needed almost that hard deadline or hard date, hard commitment to make sure that people didn't get into the habit of just not paying contributions.
Yeah, it's hard. It's very unpredictable how long it's going to last, isn't it? Because if it lasts a year, then it might be quite painful.
Without that, you're back into just encouraging employers to keep paying the legal contributions. They're legally required to pay them, but that doesn't make it happen. Or you've got to ramp up your enforcement. But I think you probably need some sort of public pronouncement at some stage. Good news, that's it. Corona is over. Everybody must be paying proper pension contributions or something like that, just to try and get everybody to understand it was temporary. Now we're back to what you should always have been doing.
And the other challenge to that is, of course, that investment returns are not really looking that rosy at the moment either, right? Give me an impression of the scheme you're advising. How is it affecting them?
I'm sorry, I disagree on that. Okay. I think it is absolutely mad. I was looking at a global passive equity, right, for one of the charities I deal with. Our global passive equity is back where it was pre-COVID.
Okay.
What?
Yeah.
This is madness.
Yeah.
This is madness.
Yeah,
How can you? And I think if you're in Nasdaq type stocks, high tech stocks, they're probably above COVID. Like, this is bonkers. The world is not the same. So, in some senses, you sort of think, wow, the market is just I don't know, overreacting. Yeah. But yeah, for a lot of cases, it was painful on the way down. Very painful.
I can see an argument for markets moving to more active investment away from index trackers, if only because if you just think about the market, if you went FTSE All Share or FTSE 100, you're picking up lots of industries that you know are going to suffer.
Yeah.
But within that, even if you look at just within one industry, within the hospitality industry, all of them are clearly going to suffer for a bit because they've been closed, will stay closed. Some of them will go to the wall because they're not financially resourced to stay in business. But the ones that come back will likely do very well because they'll have less competition. So it's quite a dispersion within industries about which stocks are going to be successful and which not. If you're a tracker, you'll just pick up the average. Someone's going to figure out that maybe we should be looking at some active management within there, and you're going to be long on the stocks that are well funded and can survive, and short on the other ones.
Interesting, yeah. So a large segment of the stock market, while they're doing really well for the time being, but they've done really terribly at the beginning of this whole crisis. So you're saying a large segment of the stock market is still overvalued, and there might be more need for thorough research on value and value analysis.
I think Andy's also making a more subtle point, which is within sectors there will be winners and losers.
Yeah.
And a good active manager should be able to say, do you know what, in the leisure industry, I think companies like this, and this will go to the wall. This one will be winners. It sounds very appealing, Andy. I put a fiver on it with you.
Yeah.
On average, I bet my boring old index will get about the same place as the average of your active managers. Sorry, that's a bit damning in the active management industry, but
So you're the advocate of active management, and you're the passive management devil's advocate counterpart there. You seem to be defending the passive side there.
I think probably partly because where you have DC schemes, you almost end up being driven automatically to passive or pseudo-passive. It could be factor type, could be factor type investment, those sort of things. But if you think of some of the factors like value or an emphasis on income or some of these things, some of those look pretty challenging at the moment.
Yeah.
So I can see there's a case for active management. I'm yet to be persuaded that the strong ones will come through.
The reality is a lot of DC schemes are still invested in passives, right? Mainly, like there's hardly any active management there.
Yeah, that's right, and for all the reasons Kevin's just said, and I'm a great advocate of passive. I just think that with some of the stocks out there today, it might be a bit obvious if you're badly funded and you're only going to survive by borrowing lots of money. Seems to me that you're going to struggle in the longer term. And I think something as simple as an ESG overlay is perhaps going to be enough. I'm not advocating full active with full pricing of that charging structure, because it's the charging structure that kills active in many cases.
Yeah. Now, a slightly different topic. What are your thoughts on COVID bonds? It's something rather new that's come up. It might not be relevant, especially for the DC schemes, but is that something you've come across, schemes investing in COVID bonds?
Not investing in them. I mean, the last article I read of any substance on them was the FT, probably a month ago. That reckoned there were about 65 billion of COVID bonds around.
Yeah.
But what do we actually mean by COVID bonds? Government or corporate? And are COVID bonds social bonds? Well, not necessarily. Depends whether they meet the ICMA social bond principles. So there's a lot of, dare I say, weasel words around COVID bonds.
Yeah.
Kevin?
It's almost in the same way that people wanted green bonds.
Yeah.
Yeah, vaguely, I spent, of the 100 million you gave me, I spent 25 quid buying a windmill. Actually, it was a windmill for the grandchildren, not one that was, you know, there was a lot of greenwashing potentially around there. There's the scope for that. I think it's probably not going to be, Andy and I both probably have a propensity to DC. I can see in the DB space, if you start talking about alternatives there's no reason why 5-10 years ago, quite a lot of schemes moved into insurance-linked securities. I could see COVID bonds having a role in that, and it should form a sensible part of those diversification strategies there, because assuming it's been properly structured, it should be well uncorrelated with markets.
Yeah. But you also need to be clear on the potential or like default rates, and those will change again by industry and again by individual stocks. So you can't just say blandly or blithely that COVID bonds are going to be good. You need to look behind them and who's offering it.
Yeah, some of the issues, I mean, they're very diverse, from emerging market governments to, I don't know, listed companies in different countries, in China, in the developed world. So it's quite.
You certainly need an advisor. You need an advisor who really understands that before you can go in here. And actually understanding it is all around the structure, and then it gets into exciting actual things like the prevalence of pandemics, the depth of pandemics, the incidence, the R rate. Everybody knows about the R rate nowadays. There was only one person in the world who knew about the R rate up until a couple of weeks ago. But we're all experts in R rates, and we all know you don't go to the Northwest or to Weston-super-Mare, which is just down the road from me. You need somebody that's going to understand in depth the truth behind that and the likelihood of future claims on it. Otherwise, these things are wonderful investments that you have a very small marginal return for quite a long period of time, and then bang, suddenly game over, and you're wiped out if you're not careful. So managing that process and getting good advice on that, absolutely essential.
Yeah, I agree entirely, Kevin. And there was an old line describing that as picking up pennies in front of a steamroller.
Yeah.
If we talk about the market more generally, I mean, across all asset classes, where do you see the key investment risks at the moment?
Well, losing your shirt, the same as they always have been. It's just, I think it's going to be more dispersion. There'll be industry-specific issues. I wouldn't want to invest in cruise liners at the moment, but also on stock-specific, as we said, hospitality or the like. And that's going to be time-related as well. So there might not be a lot of change in the first 6 months, but you could bet that in 12 to 18 months, some of these bonds will come back to bite people in the proverbial. And there's generic stuff, and this stuff is more complex and more frightening, which is assuming everything roughly gets sorted out in the next 6 months. What's going to happen to interest rates and future tax changes? What's going to change on a really strategic level?
When you say bonds come back to bite people, do you mean liquidity risk or actual default risk?
A bit of both, to be honest, but default risk specifically. But it's, what will happen with interesting?
Yeah. I think one of the interesting questions is trying to work out how much the past or the recent past is going to be a reliable guide to the future. And that'll be a challenge for asset managers, which is their whole mindset, their way of thinking, based around a certain set of assumptions about the way asset classes work, about the way investors work, about the way economies work. And or can they adapt and think, perhaps things won't be that way? And I think that's going to be quite an interesting characterization, looking at different asset managers and seeing how they respond to a very different set of circumstances. Do they assume, don't worry, things will mean revert, equities will always mean revert and we'll get back to sensible price? Yeah, maybe they're going to be right, but I suspect that quite a lot of the old assumptions may prove not to be right going forward. That's not quite the same as saying I have a rough idea which direction it's going to be, or even whether I'll know which direction it was after the event. But it's going to be an interesting process about how asset managers go about their business and the extent to which they rely on the past to help them inform the future.
Yeah, so you think they're still a bit stuck with the reference point of the last crisis, perhaps, rather than what could be the key differences now? In a way, that's the interesting question.
Yeah, I think that's a good point. I think when we started getting into it, you heard any number of people commenting saying, well, you know, if we look at what happened during the global financial crisis, and you think, that just is nothing to do with what's happening here. You know, economic growth contracted by this. Well, the reasons economic growth contracted differently in 2008, 9 and today, there's just no comparison. And to try and fit them into your model of the world and say, oh, this is just another example of this, I think that was the sort of thing that was causing me to wonder whether some people could have the switch gears mentally to adapt to changing circumstances.
That's a tricky situation to be in. So what are you advising pension schemes in terms of preparing for this situation?
Well, I delegate that one to Kevin.
Oh, come on. Come on, what are you doing on your schemes? Are you I think at the moment, I would not be suggesting people make massive tactical changes or strategic changes based on a view of the future. I think the fundamental uncertainties have just exploded rather than got narrower. So I think you're very brave indeed if you take a position. Switch everything 100% into gold today. What? Yeah, okay, people won't, but you know, tactical changes, strategic changes, it feels like it's more of a case of challenging what's sitting behind the existing portfolio and really stress testing that against potential future outcomes. I think there's quite a bit of scenario planning going on out there, not just scenarios about is it a V-shaped recovery, U-shape, or what was the other one, an L-shaped recovery. I thought That doesn't sound like it's going to recover very much if it's L shape. But I think stress testing what might happen to the portfolio and to the individual assets in some of these unknown future conditions is probably a sensible way to proceed.
I think it's also worth saying that DB schemes in particular, well, DB schemes specifically, are in a better position than in 2008, better again in 2000. You know, if you think about, they're more matching their liabilities to start with. The bit that's left over, they have the same sort of risk, but they're much closer to matching their liabilities than they have been in the past.
Yeah. So
I think that's the case. I think we were listening to a couple of presentations, and that there were more than a few DB schemes who were sort of smugly sitting there in the background saying, "Do you know what? Our funding level went up because we were massively de-risked. We were 100% hedged on interest rates and inflation, and the type of bonds that dominate our portfolio have done rather well." So it is. I think I agree with Andy. It's for a lot of schemes this is better. Equally, for the ones where they haven't learnt those lessons, if you like, and they're still running those risks, this is really quite painful. This is really quite painful.
Well, presumably it's a lot easier for DB schemes who are kind of quite mature and probably close to new members rather than, for example, DC schemes with a very big membership and a lot of big allocation to equities.
Well, yes and no. The DC schemes I've got, including the master trusts, we've looked at the actual performance in the first quarter of this year when things were really pear-shaped. And if you were in the last year or two before retirement, your fund had still gone up in value over the previous year because we'd used lifestyle and target date funds.
Okay.
And if you're 30 or 40 years away from retirement, then the jargon is you use pound cost averaging because you're buying cheap. Yeah, your existing pot's dropped quite a lot, but you've still got 30 or 40 years to go.
Yeah. Well,
I think one of the concerns, which Andy will know very well about, because I think he was the architect of it, one of the concerns was always that in difficult times like this, particularly for the auto-enrolled generation, they are going to look at what's happening and say, "Wow, get me out of here. Give me my money." Well, no, sorry, you can't have your money back. The worst you can do is opt out of schemes. But my experience so far has been very, very low opt-out rates as a result of assets dropping 30%. Don't know, Andy, if you have to say?
Yeah, absolutely. The master trusts that I've got, which have hundreds of thousands of members, they actually saw a reduction in phone calls in the first month or two, which was bizarre. But people had other things to worry about. And since then, markets have improved a bit. And as Kevin said, some of the markets are almost where they were before the crisis. So I don't think it's too much of an issue at the moment. I think it might become more of one once redundancies, as opposed to furlough, start to hit people. If we do see the comments about 3.5 people potentially being made redundant out of the hospitality industry if we don't get back to work soon, that sort of change will make a big difference to how DC does in terms of people staying active within their schemes.
August is basically when it's going to start getting really ugly. So that kind of links already a little bit to my last question. What do you think the world will look like in a year's time?
I'm not sure office space will be terribly highly valued. It's always one of the things. Will we behave differently? Will we just have got used to Zoom calls and everybody, or serious numbers of people, will now be working at home? The norm will be that people will have 2 or 3 days at home and only go into the office for the occasional team meeting. I don't know. I'd love to think that, because I think genuinely it's a better way of working and it's far more inclusive and it comes with diversity for people with family commitments and that sort of caring responsibilities, all of that sort of stuff makes it so much better. There's a horrible nagging feeling that says in 12 months' time we'll have forgotten all of that and it'll be back to where we were, and everybody will be commuting back into London and the rat race will be firmly re-established. If you ask me, I hope we're veering a little bit more away from where we were, and this will trigger a reasonably solid shift away from those ways of working.
Yeah, I'd have to agree. What I don't know is that's for today and maybe the next year, but things will start changing again. It's interesting if you look at the way the clients we deal with have adjusted their workforce, working from home, as Kevin says, even if they meant lugging their work computer, their PC back as opposed to having a laptop. But if you look to recruit people in 6 months or a year's time, the new graduates, the new school leavers, how confident are you going to be that they're going to be able to work properly without supervision? So maybe you have to bring the younger generation back into the office to keep an eye on them. Sounds a bit discriminatory, but we'll ignore that. But it means that we will gradually revert to type. So there's lots of challenges over the future, and we know that. Just look back at the investment side. There've been crashes or recessions every decade for the last 6 years since I started work, and even longer if you look at Kevin from when he started work back to 1929.
I remember the Wall Street crash in 1929.
But it just shows that we've got fairly short memories. We think boom markets will go on forever until they don't. We think this recession might go on forever until it won't. I think we will recover relatively quickly, but there will be massive changes in the way not just our market but world markets react and work.
I think your point about how will new entrants to the marketplace react, I'd position it slightly different, other than you've got to keep an eye on them, because otherwise they'll just spend their days watching Netflix on their computers or whatever. I think there's a question about how companies establish a corporate culture. How are you going to get the culture of what it's like to work for Capital Cranfield or Google or what? How are you going to develop a corporate ethos and culture if the only time I ever see people from work is on the other end of the screen? Now, not impossible, but I tell you what, people have got to work a lot harder to generate that sense of belonging, and this is the way we do things around here. You've got to work a lot harder at it. It's going to be a lot easier to do it face to face in an office, which is why there's at least a fighting chance Andy's right and people will revert to type. But I would still be optimistic that we'll get something out of it and move forward.
I think HR departments particularly will have to be more proactive, more innovative about doing stuff. I mean, how do you motivate younger generation employees if the main reason they come into work at the moment, apart from the paycheck, is the social intercourse and being able to go to the pub afterwards with their colleagues? If that isn't going to happen, what are you going to give them instead?
Yeah, that's interesting. There needs to be a new sense of purpose in a way. But yeah, there's a lot of room for thought there, and definitely some challenges. I guess we'll see how it stands the test of time. But I think we've had quite an interesting chat. So it's been really good to hear about that. And thanks very much, both of you, for your time.
Thank you.
Thank you.
Pleasure.
Speaking to
Thank you.